As we continue our discussion on financial management, in this particular section, we are going to introduce the concept of returns on various asset classes and how does that get defined in the context of financial management, as well as introduce the concept of diversification and broad premise around diversification. Right, so that's going to be the primary aspect of what is going to get covered in this particular video, diversification. And before we go there, we're going to look at what is going to be the returns of various asset classes that are there. Now, when we look at various asset classes, we've already seen broadly there are kind of two major asset classes being bonds and stocks, right? Now, within bonds, we could have G-SECs, which is government securities. So these are the sovereign bonds that are available. And currently, if you expect the annual rate of return, the approximate expected annual rate of return for the 1 year G-SEC in India is about 7.5% approximately. We are assuming that the inflation that we are counting is at approximately 5%, right? So that's the inflation. So 7.5 minus 5% will give me 2.5% yield return on the 1 year G-SEC yield. We also look at what is going to be the average risk premium compared to G-SEC. So this is the G-SEC. There is going to be no risk premium compared to itself, right? Second, we move to AAA rated corporate bonds, which is the safest category of corporate bonds. Let's say 1 year corporate bond gives us 9%. In real terms, we subtract 5% inflation to get to 4%. Now, what is the spread? The spread is between 9% and 7.5%, right? So how much extra return are you expecting out of corporate bonds when compared to the G-SEC government securities, right? So we're expecting a 1.5% extra return. That's what we have outlined here. That's the risk premium, right? That is the premium we are asking to invest in a riskier asset, asking to cover the risk. Right now, this might be the best corporate bond, but when compared to the G-SEC, it is still risky. There is a finite probability that even the safest company may not be able to repay the money that they've taken from us. Next, we move on to common stocks. General expectation in the market is common stocks give about 15% return. That's also the historical number we've seen in India. What you see is the spread between 15 and 7.5. You expect an extra 7.5% return if you want to invest in equities, right? That's an expectation because there is a bigger risk. Again, adjusting for inflation, you get a real return in equities that is close to 10%, right? That's the generic understanding of where expected returns are on an annual basis. They may or may not kind of match equally every year, but over a slightly long run, we expect the returns to be in these ranges, right? So that's what is the data. If you look at stock markets in India historically, and this is the return on the market index, on an index level, year on year return, which is every year, what is the return? So starting 1980, you see some years where it is like close to 25%. There are years where it is close to 50%. There are years where it is close to 90% as well. And then there are negative years as well, minus 20%. Then there is 2008 was a bad year, so that was close to minus 60%. So on average, when you look at these numbers, your effective average would work out to somewhere between 15 to 18% per annum return on stocks. Obviously, that depends on what is the time frame that we are using and from where to where we are looking and comparing the data points. But if you compare over a 10-12 year cycle, and why do we take a 10 to 12 year cycle? We are taking a 10 to 12 year cycle so that we get both an upturn in the market and we get the downturn in the market, right? If you take only 5 years, for example, you might end up looking at these 5 years and then say, okay, stock markets are always good. The moment you take 10 years, you start including the data where things have gone not so well as well, right? So that is why it becomes important to use a 10 to 12 year cycle. Business cycles basically span that long. Now compare this. The blue one is the Sensex return over the same period, annual return. You will see that the orange line, which is Reliance Industries, is a little bit more volatile. It moves up more, it comes down more, right? And then you see the gray line, which is Vedanta, is even more volatile. It goes up dramatically high, it comes down dramatically high as well. There are, periods where it has lost considerable amount of value in the markets, right? Now, essentially, stocks, it appears, are going to be more volatile than the market, right? They might give equal return over a period of time, maybe more return over a period of time, but they might end up becoming a little bit volatile. So what are the learnings from this particular set that we have seen? Stock market is risky, and hence there is a higher risk premium that is demanded, right? Close to about 7.5% of risk premium is demanded. Individual stocks are riskier. They are also more volatile, right? And remember, volatility means standard deviation, and we do discuss risk in the context of standard deviation or sigma. Stocks tend to move together with market over a period of time, but the returns may vary drastically in the short term. So over a period of time, about 10 years or so, the market, if it goes up, typically most good company stocks will also go up. But in the next year, it's quite possible that one stock goes up, but the market goes down. Vice versa is also true. One stock goes down, but the market goes up. Returns from stock market and stocks are unpredictable. So you can't really predict it. The only predictable return is fixed income instrument. So fixed income is predictable, right? But equities are not. Market volatility changes over time. It is highly dependent on economy and global factors as well. So if something is going wrong in the US, you could see market volatility go up dramatically, and that could create a little bit of a problem. And individual companies, they are more volatile because they have operating risk and they have financial risk. They carry these risks with them, right? So individual companies basically have an execution risk. One company might execute it better than the other,